In this video, we will take a look at the basics of the taxation of lump sum benefits. First of all, we need to start by looking at where a lump sum is included in the taxable income framework, and you'll see that it's included in gross income. However, lump sums are taxed separately, so they're not taxed using the normal tax tables that you'll use for taxable income. So the amount included in gross income is the lump sum paid out less the allowable deductions. The rate of taxation of the lump sum after these deductions depends on whether the lump sum is a retirement benefit or a withdrawal benefit. And this means that we need to decide first on the type of lump sum before we can work out the tax on it. So let's have a look at how we would categorize lump sums. And they're primarily categorized on who paid the lump sum and why it was paid. So let's first of all look at who can pay lump sums to a taxpayer. Well, firstly, it can be paid by an employer, and secondly, it can be paid from a retirement fund. We'll look at the why it's paid later. So first of all, if the fund pays the lump sum, remember there's three types of retirement funds: a pension fund, a provident fund, and a retirement annuity fund. These funds all have different rules governing them that we don't really need to know too much about for tax purposes. What you do need to know is that pension funds and provident funds are linked to an employer. So ABC employer will have ABC Pension Fund or ABC Provident Fund, and a person can only join a pension or provident fund through the company that employs them or the person that employs them. Retirement annuities, on the other hand, are not linked to employers, and they are created by investment companies. So anyone can choose to join a retirement annuity fund and start contributing to it. With a pension or provident fund, because they're linked to employment, it means that if the person changes employment, they'll need to move their retirement savings. If they access this money in that part of moving them, so it means if they use the money for their own purposes, then the money that they accessed will be subject to tax. If it's moved to a pension or provident preservation fund or to a retirement annuity fund, then it will not be subject to tax. So we've looked at who pays the lump sum. To see, we need to have a look first and see that there's two types of payments, but secondly, we need to look at why was the lump sum paid by that person or by the fund. So the first one is employers. Now, employers generally pay lump sums when someone's employment is terminated, for example, at retrenchment. And these are included in gross income, except where it is a severance benefit, and then it's taxed according to the retirement tables. So what is a severance benefit? Well, obviously it's a lump sum. It's paid by the employer, and it's for the termination of employment. But there's specific requirements. So the person it's paid to must be over the age of 55 or 55 years or older, incapable of continuing to work, so either over 55 or incapable of continuing to work, so it's because of ill health or some other infirmity. And lastly, if they're retrenched, and these are all or, so a person doesn't have to comply with all of them for the lump sum that's paid by the employer to be considered a severance benefit. And as I said, severance benefits are taxed according to the retirement tables, whereas any other lump sum benefit paid by an employer will be included in gross income and taxed with other taxable income. Okay, so if we look at why a lump sum is paid by a fund, I can't really say most common, but generally you are providing for retirement savings for retirement or when a person dies. So when a person retires, which is from a pension or provident fund, they elect to retire on or after the normal retirement age, which will be determined by the fund, or they die, then it will be considered retirement. For a retirement annuity, when a person reaches the age of 55, or if they die, it will also be considered retirement. And in that case, the retirement benefit table will be used. Where a person withdraws from a fund, this will happen for pension and provident funds when a person changes employment. So they change employers, then the fund will have to pay out whatever they've saved towards retirement. And for a retirement annuity fund, where a person withdraws their money from the retirement annuity, their savings, at any time before they're 55 years old. And generally, the funds only allow this to take place once before the person reaches the age of 55. As I say, there's some very specific rules that you don't need to know about. You need to ascertain whether the fund or has paid out because of it's a withdrawal or because it's the taxpayer is retiring. Where it's a withdrawal, then the withdrawal benefit table is used. Before the amount is included in gross income or taken to the tables, deductions can be used to reduce the taxable amount. It can't reduce it to a negative amount, so this is limited to nil. The deductions are in terms of paragraph 5 and 6 of the second schedule. The second schedule is the schedule that has all the provisions for lump sums in it, contains all the provisions. And paragraph 5 and 6 actually allow the same deductions. It's just one is for withdrawals and one's for retirement lump sums. But we can discuss them all in one slide because it's the same deductions that are allowed for both withdrawal and for retirement lump sums in order to calculate the taxable amount. So the first one that is allowed is disallowed contributions up to the end of the previous year of assessment. So any Section 11F contributions that haven't been deducted for tax purposes, where a lump sum is received, you can first reduce the lump sum with those disallowed contributions. Note that it says up to the end of the previous year of assessment. Any amounts that have to be paid over to an ex-spouse in terms of divorce orders can also be used to reduce the taxable amount. Any amounts transferred to approved funds. Now, for a pension and a provident fund, approved funds mean that it can be transferred to a preservation fund or a retirement annuity fund, and then it any amount that's transferred to those funds can be used to reduce the lump sum that was received. A retirement annuity fund can only be paid into another retirement annuity fund if it's withdrawn and transferred. And then any unclaimed benefits, sometimes funds work out excess amounts and that you'll see that they weren't paid out to the person or they haven't been claimed and they distribute them amongst the members. So long as they've already been subject to tax, they can be used to reduce the lump sum received. And then a portion of the lump sum of government funds is also not subject to tax. And then lastly, transfers on or after normal retirement age but before retirement date. So that's if a person decides to transfer out of a fund into a preservation fund after their retirement age but before they actually elect to retire. Okay, so those are the deductions, and we'll have a look at one or two of those in the example in the next video. So let's just summarize then. So first of all, lump sums can be paid from either the employer or from a fund. If it's from the employer, if the person's over 55 or has been retrenched or is incapable of working, if you answer yes to any one of those three, then the amount after deductions will be included in gross income and taxed according to the retirement table. If the person's not over 65, hasn't been retrenched, or is not incapable, and also if the lump sum hasn't been paid because of the termination of office, So then if the no is the answer, then that amount, that lump sum paid by the employer, is included in gross income and taxed with other taxable income. If you're looking at a fund, the taxpayer is over normal retirement age and elects to retire or dies. If the answer to that is yes, then that lump sum will be included in gross income after deductions. However, it will be taxed separately according to the retirement benefit table. And if the person's not over normal retirement age and they haven't elected to retire, so it's because they're withdrawing from the fund, so if the answer is no, then that amount will be included in gross income after deductions, but it'll be taxed separately according to the withdrawal table. And we'll have a look at the two different tables in the next video where we work through an example. Last thing that you need to know when calculating the tax on lump sums is that it's a cumulative tax table. So it means that all lump sums received in the past will also be added together to work out the rate at which the current lump sum is taxed. So in order to do this, you need to take the current lump sum less its allowable deductions and add to this, and please note the dates because it differs for different types of benefits. So to the current lump sum, you need to add any retirement benefits that were received by this taxpayer on or after the 1st of October 2007, or any withdrawal benefits that were received on or after the 1st of March 2009, and then any severance benefits that were received on or after the 1st of March 2011. Okay, so you can look up those dates when you're working through a question, but just make sure that you know that it's different for the different types of funds. So lump sums received less allowable deductions is equal to the prior lump sum taxable amount. So these benefits that were received, either the retirement benefit, the withdrawal benefit, or the severance benefit, are all also these net amounts after the allowable deduction. So they're the taxable lump sum benefit. Then you use the tables that are applicable to the current lump sum. So if the current lump sum is a retirement lump sum, you'll use the retirement table. If the current lump sum is a withdrawal lump sum, then you'll use the withdrawal table for this accumulated taxable lump sum that you've calculated in steps 1 and 2. And you'll calculate the tax on that according to the table. Then you'll use the tables again to calculate the tax on the prior lump sum taxable amount. So those amounts you added in step 2 above, you'll take them separate to the current lump sum and use the table to calculate the tax on them. And then the difference between the tax you calculated in 3 and the tax you calculated in 4 will equal the current tax payable on the current lump sum. Okay, just remember that rebates and medical tax credits are not set off against lump sum. So normal tax is first calculated on the normal taxable income, less rebates, less tax credits, and then to that you add the tax that you've calculated for the lump sum to give you the total tax liability for the taxpayer for the current year of assessment. And that brings us to the end of the theory side of lump sums, and in the next video we will work through an example together. I suggest that you have a look at the example and try it on your own before watching the video, or you pause the video, but let's look at that in the next one. Thank you.